Every second, billions of dollars change hands in a place you cannot see. There are no buildings, no noise, just numbers moving like a living pulse. This unseen world is the stock market, where value shifts constantly, driven by forces that are both logical and emotional. It's a realm that operates silently, yet its impact is felt everywhere, from the prices of everyday goods to the fortunes of global companies. As we begin our journey, let's explore what makes this market tick and why its movements matter to us all. The heart of the stock market lies a simple question: what decides a company's value? This question is more than just numbers on a screen. It's about understanding the forces that shape the worth of businesses we know and trust. Whether it's a tech giant or a local shop, the answer to this question influences investment decisions, shapes economies, and affects millions of lives. Let's dive deeper into how this value is determined and why it matters. Stock market began with a radical idea. Instead of owning an entire company, people could own tiny pieces of it. These pieces are called stocks, shares of real businesses like Apple or Amazon. This innovation allowed ordinary people to participate in the growth and success of companies, spreading risk and opportunity across a wider population. The concept transformed how businesses raise money and how individuals build wealth, laying the foundation for the modern financial world. Stocks represent ownership in a company. When you buy a stock, you own a small part of that business. This means you share in its profits, losses, and future potential. Companies like Apple and Amazon issue stocks to raise money for growth, and investors buy them hoping their value will rise. Stocks are traded every day, with prices changing based on how people feel about the company's prospects. It's a simple idea, but it powers a complex system. Stock market isn't a place of magic or gambling. It's an auction that never stops. Buyers and sellers constantly agree on one thing: price. This ongoing negotiation creates a dynamic environment where prices reflect the collective wisdom and emotion of everyone involved. The market is always open somewhere, and its pulse never fades. Understanding this auction process is key to grasping how values are set and why they change so quickly. Every transaction in the stock market is based on agreement. Buyers and sellers come together, each with their own reasons, and settle on a price. This price is not fixed, it moves as new information, emotions, and expectations enter the market. The process is fluid, reflecting the ever-changing landscape of business news, global events, and investor sentiment. It's this constant negotiation that makes the market so fascinating and unpredictable. The price of a stock is driven by two fundamental forces: supply and demand. When more people want to buy a stock than sell it, the price goes up. When more want to sell than buy, the price goes down. These forces are simple in theory, but in practice they are influenced by countless factors, from company performance to world events. Supply and demand are the heartbeat of the market, shaping every price movement. Supply and demand are powered by something far more unpredictable: human emotion. Confidence, fear, hope, and greed all play a role in how people buy and sell stocks. When investors feel optimistic, they rush to buy, driving prices up. When they are scared, they sell, causing prices to fall. These emotions can change quickly, making the market volatile and exciting. Understanding the emotional side of investing is crucial for anyone wanting to succeed. Confidence rises, people rush to buy stocks. This surge in demand pushes prices higher, often creating a sense of momentum. Investors may be reacting to good news, strong earnings, or positive forecasts. The market becomes lively and optimism spreads. But this confidence can be fragile, easily shaken by unexpected events. It's important to recognize how quickly sentiment can shift and how it impacts stock prices. If fear spreads, the opposite happens. Investors rush to sell, causing prices to fall. This can be triggered by bad news, disappointing results, or global uncertainty. The market becomes tense and pessimism takes hold. Fear can lead to rapid declines, sometimes faster than confidence can build. Recognizing the signs of fear in the market helps investors make better decisions and avoid panic selling. Nothing about the company has to change instantly for its stock price to move. What changes is belief about the future. Investors constantly reassess their expectations, reacting to news, rumors, and forecasts. This shifting belief is what drives the market, often more than actual results. Understanding how expectations shape prices is key to navigating the stock market successfully. Single headline, product launch, or rumor can move billions in value within minutes. The market reacts not just to facts, but to expectations about what those facts mean for the future. News travels fast and investors respond instantly, sometimes before the full story is known. This rapid reaction can create big swings in stock prices, highlighting the importance of staying informed and thinking critically. Market is not just reacting to facts, it is reacting to expectations. Investors try to anticipate what will happen next, making decisions based on predictions rather than certainty. This focus on the future makes the market both exciting and risky. It's not enough to know what is happening now, you have to guess what might happen tomorrow. Expectations are the invisible force behind every price movement. Any beginners miss the emotional and psychological side of the stock market. They focus on numbers and charts, forgetting that every price is shaped by human behavior. The market is less a machine and more a reflection of psychology under pressure. Recognizing this helps investors avoid common mistakes and make smarter choices. It's not just about analysis, it's about understanding people. Stock market is a mirror of human psychology under pressure. Greed pushes prices up, fear pulls them down, and hope keeps the market alive. These emotions are always present, influencing every decision and every trade. By studying market psychology, investors can better predict movements and manage their own reactions. It's a powerful tool for anyone wanting to succeed in investing. Greed is a powerful force in the stock market. When investors see opportunities for big gains, they rush to buy, driving prices higher. This can create bubbles where prices rise far above their true value. Greed can be contagious, spreading quickly and leading to risky behavior. Understanding how greed influences the market helps investors stay grounded and avoid chasing unrealistic returns. Fear is just as powerful as greed. When investors worry about losses, they sell quickly, causing prices to drop. This can lead to panic selling, where fear spreads and prices fall even further. Fear often follows bad news or uncertainty, making the market unpredictable. Recognizing the signs of fear can help investors stay calm and make better decisions during turbulent times. Hope is the glue that keeps the market alive. Even when prices fall, investors look for signs of recovery and new opportunities. Hope drives innovation, encourages risk-taking, and fuels long-term growth. It's the reason people keep investing even after setbacks. Understanding the role of hope helps investors stay positive and focused on the future. When you watch the stock market, you are not just watching numbers. You are observing millions of people trying to guess the future together in real time. Every price movement reflects collective hopes, fears, and predictions. The market is a living organism shaped by the actions and beliefs of countless individuals. By watching closely, you can learn to spot trends and understand the bigger picture. Stock market is a place where millions try to guess the future. Investors analyze news, trends, and data, hoping to predict what will happen next. This guessing game is never-ending, with new information arriving every second. Success depends on staying informed, thinking critically, and adapting to change. The future is uncertain, but the market rewards those who can anticipate it. Stock prices move in real time, reacting instantly to new information. Whether it's a breaking headline, a product launch, or a rumor, the market responds within seconds. This speed makes investing exciting but also risky. Investors must be ready to act quickly but also carefully. Real-time reactions highlight the importance of staying alert and making informed choices. Stock market is powered by collective wisdom. Millions of investors bring their knowledge, experience, and intuition to the table. This diversity creates a rich environment where ideas compete and evolve. The market's price reflects the sum of all opinions, making it a powerful tool for understanding what people believe about the future. Stock market operates like a never-ending auction. Buyers and sellers compete, each trying to get the best deal. This competition creates dynamic price movements, sometimes fast and sometimes slow. Understanding auction dynamics helps investors recognize opportunities and avoid pitfalls. It's a game of strategy, patience, and timing. The stock market is not a place of magic or gambling. It's built on logic, negotiation, and information. Every price is the result of careful analysis and emotional reaction. Investors use data, research, and intuition to make decisions. The market rewards those who think critically and act wisely. Information is the lifeblood of the stock market. News, reports, and forecasts shape investor decisions and move prices. Staying informed is essential for success. Investors must filter out noise, focus on key facts, and react quickly to new developments. The right information can make all the difference. Rumors can move the market just as much as reality. Sometimes a whisper or speculation is enough to trigger big price swings. Investors must learn to distinguish between fact and fiction, staying cautious and skeptical. Rumors can create opportunities but also risks. Navigating this landscape requires skill and patience. New product launch can send stock prices soaring or crashing. Investors react to the potential impact on sales, profits, and reputation. The market responds instantly, reflecting both excitement and skepticism. Successful launches can create lasting value, while disappointments can lead to sharp declines. Understanding how product launches affect stocks is key for investors. Volatility is a defining feature of the stock market. Prices can swing wildly in response to news, rumors, and emotions. This volatility creates both opportunity and risk. Investors must learn to manage uncertainty, stay calm during big moves, and avoid reacting impulsively. Volatility is not always bad; it can lead to profits for those who are prepared. Risk management is essential in the stock market. Investors use strategies like diversification, stop-loss orders, and careful research to protect themselves. The goal is not to avoid risk entirely, but to manage it wisely. Understanding your own risk tolerance and planning ahead can make investing safer and more rewarding. Successful investors often take a long-term perspective. They focus on the big picture, ignoring short-term noise and volatility. Long-term investing requires patience, discipline, and confidence in your strategy. By staying committed, investors can ride out ups and downs and achieve lasting success. Short-term trading is fast-paced and exciting. Traders buy and sell stocks quickly, trying to profit from small price movements. This approach requires skill, attention, and a willingness to take risks. Short-term trading can be rewarding, but it's not for everyone. Understanding the difference between trading and investing is important. There are many types of investors in the stock market. Some focus on growth, others on value, and some prefer income. Each approach has its own risks and rewards. Understanding your own goals and style helps you choose the right strategy. The market welcomes all kinds of investors, creating a diverse and dynamic environment. Growth investors look for companies with strong potential to expand. They focus on innovation, new products, and market trends. Growth stocks can deliver big returns but also carry higher risk. This approach requires research and a willingness to take chances. Growth investing is popular among those seeking excitement and opportunity. Value investors seek stocks that are undervalued by the market. They look for bargains, buying when prices are low and waiting for recovery. Value investing requires patience and careful analysis. It's a strategy favored by those who believe in fundamentals and long-term growth. Value investors often avoid hype and focus on real results. Income investors focus on stocks that pay dividends. They seek steady returns and reliable companies. This approach is less risky but also less exciting. Income investing is popular among those looking for stability and regular payouts. It's a good choice for long-term wealth building. Market trends shape the direction of stock prices. Trends can be upward, downward, or sideways. Recognizing trends helps investors make better decisions and spot opportunities. Trends are influenced by news, economic data, and investor sentiment. Staying aware of trends is key to successful investing. Stock market is closely tied to the economy. Economic growth, inflation, and interest rates all influence stock prices. Investors watch economic indicators to predict market movements. Understanding the relationship between the market and the economy helps investors make smarter choices and avoid surprises. Global events like wars, pandemics, and political changes can move the stock market dramatically. Investors react to uncertainty, adjusting their strategies and expectations. Staying informed about world events is crucial for managing risk and spotting opportunities. The market is always watching the world. Companies' performance is a major factor in its stock price. Earnings, sales, and growth all influence investor decisions. Strong performance attracts buyers while weak results lead to selling. Investors analyze company reports to gauge future potential. Performance is the foundation of value. Expectations about the future drive the stock market. Investors try to predict what will happen next, making decisions based on forecasts and analysis. These expectations can change quickly, creating volatility and opportunity. Understanding how expectations shape prices is key to successful investing. The stock market is a place of collective action. Millions of people buy and sell together, creating a powerful force. This collective behavior shapes prices, trends, and opportunities. Understanding how group dynamics work helps investors anticipate movements and make smarter choices. The stock market is a reflection of belief itself. Prices are not just numbers, they represent what people think, hope, and fear about the future. The market is a mirror, showing us the collective psychology of investors. By studying this reflection, we gain insight into human nature and the forces that drive value. In the end, the stock market doesn't just price companies, it prices belief itself. Every price is a measure of what investors think will happen next. Belief is powerful, shaping fortunes and futures. Understanding how belief drives value helps investors make better decisions and see beyond the numbers. Stock market is shaped by many forces: supply and demand, emotion, information, and belief. Each plays a role in setting prices and creating opportunity. By understanding these forces, investors can navigate the market with confidence and skill. The journey is complex, but the rewards are great for those who learn and adapt. Stock market is more than numbers and charts. It's a living pulse reflecting the hopes, fears, and beliefs of millions. By understanding what drives value, investors can make smarter choices and build lasting wealth. The market is always changing, but its core remains the same. It prices belief every second in real time.